Good morning and welcome to Weekly Insights with John Plassard. Tomorrow's night Fed meeting could prove to be the most important in 20 years. Policymakers on the Federal Open Market Committee, the FOMC, are expected to rise interest rate tomorrow night by a 0.5 percentage point hike. It will mark the first rate increase of such magnitude since 2000. That expected bump breaks from the previous tightening cycle's tradition of gradually tapering the brakes on the economy in quarter-point baby steps. That's because officials may be able to move a few times and then back off rather than gradually hike interest rate for an extended period of time in smaller quarter-point increments. It's also the first time in 16 years that officials have hiked borrowing costs at back-to-back gatherings after the U.S. Central Bank's quarter-point rate hike in March. The Fed could announce plans to start shrinking its near $9 trillion bond portfolio at a likely pace of $95 billion a month. If so, that will be nearly twice as fast as the previous time officials delved into trimming the money supplies in 2017. The move could zap even more stimulus from the financial system, translating to even higher mortgage and long-term borrowing rates for consumers. Some experts even say that drawdown impact could be even greater than rate hikes. Those assets include both longer-date treasuries and mortgage-backed securities, as well as shorter-term bills. Their yield acting as another important consumer borrowing cost benchmark. That means loans at varying maturity could be impacted. Consumers very well could see an even more aggressive U.S. central bank down the road if investors' expectations come to fruition. Market participants are bracing for the Fed to hike at all 6 gatherings this year, with a 75 basis point increase on the table for June. That rate jump will be the biggest move since November '94 and the second of its kind. Yes, consumers could feel an even tighter pinch, especially when it comes to mortgage rates. A Bank Trade National survey of lenders found that cost of financing a home has jumped by 2 percentage points on average, climbing to 5.22% in the week that ended April 27. Bigger spikes than this one have happened before, but never one at this speed. Officials have a destination in mind. They want to hike interest rate past the point in which they are no longer stimulating growth. That threshold is the so-called neutral rate of interest, which was believed to be around 2.5% in the previous economic expansion. Thank you very much. Have a great week. And of course, keep on winning.